Hi, I'm Tekoa De Silva, and with me here today is John Williams, publisher of Shadow Government Statistics. John, welcome. Thank you for joining me.
Thank you, Tekoa.
So, John, I've been following your inflation commentary and your public interviews for most of my adult life. But for the person watching who might not be familiar with your background and your work, what do you track and what do you produce in your publication?
I look at the government statistics, major ones that are followed by the public, as well as trying to assess where the underlying reality is in terms of the economy and inflation. Economic activity is measured by the GDP, the CPI, the inflation is measured by the Consumer Price Index. In particular, are numbers I look at and analyze. I look at the government's reporting, where they play games, where they change things. And over time, particularly with the CPI, which is used so broadly by individuals in commerce, the numbers that they're reporting are very heavily understated. And that goes back to a point in time where back in the 80s and early 90s, where the Congress was upset by there being a big boost in the cost of living adjustment to Social Security, which is due to higher inflation or higher reported inflation, because that cut into the deficit spending that they could do, at least described to me by people in Congress. So what they did was they looked for ways to reduce the headline inflation. And I have a quote here. This is from the Catherine Abraham, who was the Clinton Bureau of Labor Statistics Commissioner. She remembered sitting with the House Speaker, Newt Gingrich, at the time. And he said, quote, he said to me, if you could see your way to clear doing these things, we might have more money for the BLS program, Bureau of Labor Statistics. What he wanted to do was for them to find a way to lower the cost of living adjustments so that they weren't hit so hard in terms of the extra deficit spending that they could do.
So if I understand you correctly here, John, these adjustments to the consumer price inflation measurement put out by the Bureau of Labor Statistics, the adjustments were made to reduce their stated rate of inflation in order to shortchange the Social Security recipients. Is that right?
That is correct. I mean, they're very open about it. They look at the Gingrich's comments with Catherine Abraham. The gist of it was, hey, we've got to bring down the headline cost of living number for Social Security here because it's killing our ability to spend the money we want to spend. And the Bureau of Labor Statistics accommodated.
I'd like to ask you a question, John, about how you entered into this work. I understand that earlier in your career, you were providing a private economic consulting work to a commercial airplane manufacturing company.
I went to the Dartmouth and the Tuck Business School, and at Tuck I got into econometric modeling, where you have the ways of mathematically working out relationships between different variables, and sometimes you can work out a meaningful equation or relationship that helps you forecast, particularly where you have a leading relationship, what might be happening in the future. I was in a family business, and I did some modeling there. We sold the family business, and I started up my own economic consulting firm and did specific work for private companies. And in the process, as this evolved and as the CPI circumstance evolved, which was in the course of my work experience. I got out of school back in '71. When the government did what they did, I took offense at that. I mean, they're not living up to the agreement with the average American, and I started tracking it and started publishing the numbers on it. It just evolved since then. I have done a lot of work with the employment and unemployment, where the government also has had some happy adjustments to the numbers that make the unemployment rate look a little better than it is. And as I got the alternate numbers together, I started publishing a newsletter called Shadow Stats, and that covers alternate estimates of the consumer price index, the way it used to be calculated, the GDP, the same thing. The GDP is just a nonsense number. The CPI is a very serious one because that affects people's livelihood. I also look at the employment and the unemployment, and there's some serious issues with the employment number. And I look for consistency in the numbers over time. You don't just redefine numbers and then not talk about it. at least in the private sector, you have to have consistency in your reporting. Or if you don't, you at least have good footnotes on it. You've had a number of changes. I mean, again, with the CPI, those changes were made after the deal was made on setting the cost of living adjustment. That was based on the CPI of the time. But there was no clause in there, gee, should the government change the CPI to reduce it, it will reduce the payment. If that were a private contract, that your original deal would have held, you still would have had that same cost of living adjustment that you had agreed to when you went to the government to take on the Social Security payments. They changed the terms after people made the deal with them. That's very difficult to do in business and have it accepted. The government can get away with all sorts of things. And with the unemployment, what they do is the headline numbers, they survey them. But there's a question in terms of the discouraged workers. If you're unemployed, they'll count you as unemployed. If you're unemployed and you're not actively looking for work because you've given up looking for work, there's no work to be had, they then count you as a discouraged worker. And there they'll count you for 6 months. But after 6 months, if you're still discouraged, they don't count you. I continue counting them. I mean, if people are discouraged and they want to work and there are no jobs to be had, they're still unemployed as far as I'm concerned. So I get a much higher unemployment rate than the government does with its headline numbers. They also have alternate measures, but I can tell you that there are more people unemployed when you look at the broad discouraged worker category than otherwise. And probably the worst number published by the government is one of the most widely followed. And that's the gross domestic product. How's the economy doing? It's far from a hard number. You have all sorts of components within the gross domestic product, total measure of economic activity in the United States. It's estimated in nominal terms. That's before you adjust for inflation and after inflation. If you look at the GDP, total U.S. economy, total economic activity, what you've been seeing for the last several quarters is that year-over-year growth, and this is adjusted for inflation, is running around 3. Right now, I think it's around 3.5%. It was up at 3.5%, maybe 4% going back a couple of quarters, but it's still up over 3%, which is still plus economic growth. There's a problem with that. I look at every economic statistic that I can and follow it and look for unusual traits. And one of the best indicators I follow, which is a private one, is called the Cass Freight Index. The Cass Freight Company. They track domestic freight. You don't have a better indication of broad economic activity than freight activity, the shipments of goods and such. Right now, that's down year over year. It's been down year over year for some time. But you look at retail sales. Retail sales is reported in nominal terms. That's before they adjusted for inflation. But the economic numbers are usually adjusted for inflation because otherwise what looks like economic growth may be just inflation. So using the headline consumer price index, which is understated, and then if you have understated inflation and you're deflating by understated inflation, that will overstate the real growth, the growth that's adjusted for inflation. So one of the gimmicks the government has is deflating things by understated inflation. But I'm just using the government's numbers here. If you use the headline retail sales and you adjust it for the consumer price index to look at it net of inflation, it's down year to year. So is industrial production. The Cass Freight Index I mentioned, that's also down year to year. Housing starts, down year to year. All the monthly economic numbers are down. The key economic numbers are down year over year, yet the GDP is up 3% plus. That's nonsense. The GDP is very heavily constructed and gimmicked, and we've just had an election. What can I tell you? The GDP gets its headlines, but the underlying economic activity is not growing, and I can tell you that the monthly economic statistics are of much better quality than the GDP. So my contention would be that the U.S. economy right now is stagnant to negative based on the monthly numbers. And I think you'll see some downward revisions and reporting in the GDP as we go along now that we're past the election. But there's nothing new there. Those things have happened many times before in the last 15, 20 years. It's a bonus that you have if you're the government and you report the numbers. You can sometimes tweak them a little bit to help yourself politically before elections.
Okay. Well, so we're having this conversation here in December of 2024. What are your figures showing you in terms of what the likely annual consumer price inflation rate is in the USA year currently?
Right now, the headline is 2.6%. That's what the government's saying year over year. And that's the way they look at it, is 2.6%. Consistently measured over time, where they didn't start playing games with how they measure the CPI, that'd be up around 10.4%. It's a difference of about 8 percentage points.
Thank you for that, John. And before the interview, you were kind enough to send me a chart, and it helps with my next question here, which is there a correlation with the US dollar gold price over time and your compounded inflation figures? And so I'm just going to add this slide in here. So this is just an amazing chart that you sent me here. And when I look at this, it looks like there's a real tight correlation between your alternate CPI, your Shadow Stats publication, and the gold price over time. Could you walk us through this chart here, please?
Sure. What you see here is 200 years worth of, I think it's 200, more like 300 to 400 years back to the 1680s. Mm-hmm. Which shows the headline inflation of the time, or the best estimate, against the price of gold. The inflation here is the consumer price index, or at least part of it is. And that is estimated by the federal government. But if you look at the right-hand side, you'll see there's a line that splits in two, one that's at a lower level and the one that starts to rise. The one that's at the lower level is the official headline consumer price index. The one that starts to rise is my alternate estimate based on what they started subtracting out of it as to where this is just the index level. It's not year-to-year change, but it's the index level. The more ragged line is the annual price of gold. And over time, what you'll see is that gold is your best hedge. If you hold physical gold, it's the best hedge you're ever going to get against actual inflation over time. Where you see there's a common starting point there where they all come together. I think it was back around 1980. But at that point in time, there was just pure coincidence. The headline price of gold and the CPI index level numerically were equal, so that the scale there is the index or the price of gold. You'll see that there, but it's all based on whatever year they were equal in. So what you're seeing there is a parallel measure of two series that are effectively have moved together over time. And where you see the rough movement there, that's the price of gold. People have anticipated crises. They've anticipated inflation. Over time, it's anticipated and stayed with or ahead of inflation. Right now, I think this chart shows it a little bit ahead of inflation, and at the moment, inflation is the two of them move together up together. They're about at the same level right today. So they're still moving together. So what I have recommended over time is that if you're looking at an inflation hedge, look to hold physical gold. And when I say physical gold, normally I would suggest common date bullion coins or gold coins that don't have a big numismatic value, but just basically reflect the metallic value, the gold value, because the numismatic value doesn't help you here at all, but it does. The actual metallic value has worked out as a big hedge over time. And as you'll see there, it took a while for the headline CPI to catch up with the gold price, but it sure did, and the gold price anticipated it, and it's still anticipating it. You've just seen the big surge that you see from the lower level to where we are now has just been in the last year, and the gold has been anticipating the inflation. It's not perfect; you get volatility, but again, if you hold the physical gold as a store of wealth, I think that will probably do as good a job as anything to protect your purchasing power over time. It's not perfect, but over the years it has worked.
I'd like to ask you a very broad question now, if I may, and hopefully it's not too broad, but it seems like the political environment that we're in now globally, it seems a lot more volatile than it has been in the past, certainly during my short lifetime. When you look at what's going on with the few wars that are occurring around the world that look like they may grow possibly in intensity, and the political saber rattling, if I could put it that way. And then when you look at the deficit, the fiscal situation here in the U.S., what goes through your mind, given what you know and what you study about the future for the U.S. dollar, for CPI, and maybe for gold prices too?
Well, again, let me start with gold. It'll tend to move with the inflation and protect the purchasing power of whatever currency you're in. That's been the nature of the metal over time. Right now, I think we're in a very dangerous circumstance in the United States, both from an inflation standpoint and an economic standpoint. Leading indicators that I have on the economy suggest that the real economy is flat to minus, and it's going to tank. And not just in future. I'm not seeing any upturn there. It's getting weaker. At the same time, the inflation numbers are getting worse. And what's driving the inflation right now, if you look at it in terms of the U.S. dollar, and gold is also denominated in the U.S. dollar, it's several-fold, and not quite as advertised. The Fed, it's a central bank. Its primary clients are the banking system. It also has responsibilities for the monetary policy for the country. Its primary concern is keeping the banking system solvent and afloat. And if you look at where the inflation came from here, when we hit the pandemic, that disrupted the whole system. It triggered inflation, triggered rough economic times. The Fed pumped 30 years worth of monetary stimulus into the system in a month, 2 months. That was to keep the system afloat, to keep the banking system afloat. The Fed's primary concern here remains the banking system. That was extraordinarily inflationary. The money supply and still is pushing the inflation. There's another factor, and it's being done by the federal government. It's the extreme deficit spending and such by the federal government. Those two factors are driving the inflation. Now, if you go back to the days when the pandemic hit and the Fed took its initial action to put a surge, the money supply, they put in 30 years worth of stimulus in a month to support the system. You started seeing inflation. And the Fed said, oh my goodness, the reason for the inflation is that the economy is overheating. Nonsense. There never was an overheating economy during the pandemic. I challenge anyone to find that. But they used that as a justification for raising interest rates. They needed to pump the money into the system to support banking liquidity, and they needed to raise the rates to keep the banking system solvent. Their primary function is to protect the banking system. And the big inflation problem came from the money supply creation, and still is there. The money supply is still there. The growth may be flat month to month now, but if you looked at their money supply growth at the end of the first year, you saw a big surge in the money supply. The money supply was up order of magnitude 58% year over year, and that's really unprecedented. But that's what gave you the headline inflation. That's still there. I mean, you may have seen that money supply is flat, been flatter month to month and such. But the year to year change where it was against where it was pre-pandemic is still there. They haven't taken it out. That's what's been driving the inflation. They know it. Their actions, their excuses, what they're doing, again, are all flavored by what has to be done to keep the banking system afloat. It's a conflict of interest that's never been resolved that I can see. On the other hand, the federal government has been very open about what it's doing. It's just been spending money without any concern about containing it, with the effect that the federal deficit is uncontained. It just keeps growing and growing and growing. Both those factors, the Fed's money supply and the federal debt and deficit, are driving the inflation. And the headline inflation is really not coming down. I'm looking at, as it used to be counted, something up at 10.4%. That might be down from a pandemic high of 16%. That's year over year, but the bulk of what was put into the system is still there. So the year-to-year numbers are not quite as meaningful as they might be. If you look at the money supply numbers, the Fed's year-to-year money supply is up 5% plus or minus, but it's still up 50% from where it was pre-pandemic. And that's unprecedented. They did what they had to do to hold the banking system together. It's a dangerous circumstance. And what I'm looking at ahead is still higher inflation, but we're now beginning to see signs of the recession beginning to take hold. And you're seeing that. It's been there in the underlying economic statistics. Again, if you look at retail sales adjusted for inflation, that's when you look at the broad economy, normally you take inflation out of it so that you're not looking at growth that's just due to rising prices, but you're looking at growth due to the actual physical volume of sales. The retail sales, even using the government's headline inflation, are negative year to year. Industrial production, not negative year to year. It's below pre-pandemic levels. Same thing with industrial production, with the housing. We've never recovered those pre-pandemic levels. So it's amazing that the Fed showing the banking system as healthy as it is. GDP's up, but not the underlying numbers. The underlying numbers that are the actual representation of economic activity as the average person sees it. They're not doing well. We've never really recovered from the pandemic-driven economic collapse. We're in a very difficult circumstance right now where you're not seeing year-over-year growth in the broad economy. At the same time, inflation is being spiked by the Fed. It's the worst of both worlds. And I think you're going to see difficult times in this year ahead. I mean, looking a year ahead, I would expect we're going to have both higher inflation and weaker economic growth than we do today. And that's a very bad circumstance. Very bad.
All right. Well, John, are there any other thoughts or questions that you think that I may have missed?
I think you've pretty much covered the spectrum. Always open to discussing things, and generally, I mean, and I know my numbers are somewhat controversial. I mean, I'm looking at a much stronger inflation picture and much weaker economic picture than is common. But again, the government's biases, which is in the government being political and the Fed being political and the Congress being political, that they do what they can to try and boost the headline economic numbers and depress the CPI numbers. What we had with the pandemic, it just disrupted everything, put circumstances in turmoil. It's beginning to calm down, but the damage is still there. The liquidity driving the inflation is still there, but it's needed to keep the system stable and solvent. It's still a dangerous time, and the best bet I can give you is I'm looking forward a year from now is that you're going to see higher inflation, weaker economic growth than are being currently reported, and possibly extremely higher and worse. It can be a very dangerous circumstance. I would urge people that do not currently own at least a minimal amount of physical gold, and I'm not talking collector's coins that are worth much more than their metallic value. I'm just talking metallic gold in coin form. There's a lot of different coins that are basically the value is just whatever the value is of gold, plus a small premium or such. It is the physical gold that is probably your best hedge over time, if we get into a difficult circumstance, and there's a risk here of a hyperinflationary circumstance and effectively a hyperinflationary economic collapse. I mean, that would be the worst of all worlds. And the gold would be the type of thing that would preserve your purchasing power in terms of a runaway inflation. That's been seen time after time after time where there has been runaway inflations. So if you have the collector's coins are fine, and then they'll still work as gold pieces. You can get gold coins that have effectively a price that's the same thing as its metallic value. And the reason for having the coin is that people don't have to say the gold if you're using it to barter or trade for something. It'll be recognized, and it's a good barterable good as it is.
John, you've just given me some information there for another question here for you, and that is that, so you mentioned that the risk of a possible hyperinflationary scenario. Do you think that would be a matter of the perception of the global public, of people who use the dollar, of just deciding that they don't want it anymore? And or do you think that would there be early warning indicators that you would see to say, oh boy, something like that is imminent? Is there anything a person can sort of do to foresee it as an impending event, or you just have to wait and see if it happens, kind of thing?
I'd watch the price of gold. You see a surge in the price of gold, that would be an indicator. The government's going to try and mask as much as they can, and they are masking, and they have been masking the inflation rate for some time. I figure it's underestimated right now year over year by 8 percentage points. I think that'll pick up, but the number that will pick up should pick up in the numbers. I mean, whatever's built into the CPI to contain it, that's already containing that probably will not have much of a broader impact. Might be a little slower picking it up, but I think you'll see in the headline numbers a real pickup. But watch the gold price. If they see the surging gold price, I would look at that more as a more reliable indicator of the current purchasing power of the dollar, which is what inflation measures. You have high inflation, you have a lower purchasing power. You buy less. You can buy less goods with a higher inflation. So I'd watch the price of gold. You see soaring price of gold against the U.S. dollar, and you're not seeing a big movement in the CPI. I'd question the CPI. 6.
All right, Mr. John Williams, thank you so much for sharing your comments with us today. It's been an absolute pleasure.
Thank you, sir. I greatly appreciate your having me on your show.
All right, thank you. Thank you for checking out today's interview video with John Williams. What are your thoughts? What did you think about it? What is the inflation rate like where you are, wherever you are in the world? What do you think about John's awesome chart? At least I thought it was very cool, showing his inflation rate over time and the correlation with the gold price. Do you think that the gold price is well correlated to the inflation rate over time? I would love to hear your thoughts. Do you want to hear more of John? What questions would you ask him? Leave a comment down below, and I'd love to hear your thoughts. Thanks for watching, and have a good day.